Mental accounting. How we categorize money. Introduction. Money, in its purest form, is neutral. A 100 Indian rupees note is worth the same regardless of where it comes from or how it is spent. Yet, in reality, people do not treat all money equally. We behave differently depending on whether the money is a salary, a gift, a bonus, or even winnings from a lottery. This phenomenon is known as mental accounting. Mental accounting is a concept in behavioral economics that explains how individuals categorize, evaluate, and track financial activities in their minds. Instead of treating money as fungible, interchangeable, people mentally divide it into separate accounts based on subjective criteria, such as source, purpose, or emotional significance. This script explores the concept of mental accounting in depth, its meaning, origins, principles, examples, advantages, disadvantages, and real-world implications. Meaning of mental accounting. Mental accounting refers to the cognitive process by which people organize, categorize, and evaluate financial decisions. Instead of viewing money as a single pool of resources, individuals divide it into different mental categories. For example, salary used for necessities, bonus used for luxury spending, savings not touched, lottery winnings spent freely. Even though all money is technically identical, these mental labels influence how people spend, save, and invest. Origin of the concept. The concept of mental accounting was introduced by Richard Thaler, a Nobel Prize-winning economist. He challenged traditional economic theory, which assumes that individuals make rational decisions and treat money as perfectly fungible. Thaler argued that people often behave irrationally due to psychological biases, and mental accounting is one such bias that affects financial behavior. Key principles of mental accounting. 1. Categorization of money. People divide money into different mental accounts, such as household expenses, entertainment, savings, investments. This categorization influences spending decisions. 2. Non-fungibility of money. Although money is fungible, mental accounting makes people treat it as non-interchangeable. Example, a person may refuse to use savings for a vacation, but freely spend a bonus on the same trip. 3. Framing effect. The way money is presented affects decisions. Example, you got a 500 Indian rupees discount. Feels different from, you avoided losing 500 Indian rupees. Even though both are the same, perception changes behavior. 5. Budgeting behavior. Mental accounting helps people create budgets, even if they are informal. Example, I have 2,000 Indian rupees for food this week. Types of mental accounts. 1. Current income account. This includes regular earnings like salary. People tend to spend this carefully. 2. Asset account. Saving, investments, and long-term funds fall under this category. People are more protective of this money. 3. Future income account. Expected income such as bonuses or expected profits. People often plan spending in advance based on this. Examples of mental accounting. Example 1. Movie ticket scenario. If someone loses a 200 Indian rupees movie ticket, they may decide not to buy another one. But if they lose 200 Indian rupees cash, they may still buy the ticket. Reason: the loss of the ticket is categorized under entertainment, while cash is general money. Example 2. Windfall gains. Lottery winnings or unexpected money are often spent more freely. Example, a person may spend 5,000 Indian rupees lottery winnings on luxury items, but hesitate to spend the same amount from salary. Example 3. Credit card spending. People tend to spend more when using credit cards because the payment is mentally separated from the purchase. Example 4. Discounts and offers. People may travel far to save 100 Indian rupees on a small item, but not do the same for a larger purchase. Advantages of mental accounting. 1. Helps in budgeting. Mental accounting helps individuals allocate money for different purposes. 2. Encourages saving. By separating saving from spending money, people are less likely to use it impulsively. 3. Financial discipline. It creates a sense of control over finances. 4. Goal-oriented spending. People can save for specific goals like education, travel, or emergencies. Disadvantages of mental accounting. 1. Irrational decision-making. People may make poor financial choices due to artificial categories. 2. Ignoring opportunity cost. Money in one account could be better used elsewhere, but people refuse to shift it. 3. Overspending. Extra money like bonuses is often spent unnecessarily. 4. Debt mismanagement. People may keep savings while carrying high-interest debt instead of paying it off. Mental accounting in daily life. Mental accounting influences many everyday decisions. 1. Shopping behavior. Buying unnecessary items during sales. Spending more due to cashback offers. 2. Savings habits. Keeping separate accounts for different goals. Avoiding touching fixed deposits. 3. Investment decisions. Holding losing stocks too long. Treating profits differently from principal. 4. Entertainment spending. Allocating fixed budgets for leisure activities. Mental accounting in business. Real-life case studies. Case 1. Salary versus bonus spending. Employees often save salary but spend bonuses on luxury items. Case 2. Tax refunds. People treat tax refunds as extra money and spend it rather than save it. Case 3. Gambling behavior. People treat winnings differently from their own money, leading to risky behavior. How to avoid mental accounting bias. 1. Treat money as fungible. Recognize that all money has equal value. 2. Focus on overall wealth. Look at total financial position instead of separate accounts. 3. Consider opportunity cost. Always think about alternative uses of money. 4. Rational budgeting. Create budgets based on logic rather than emotions. 5. Pay off high-interest debt first. Do not keep savings while paying high interest on loans. Mental accounting and technology. Modern apps and digital tools reinforce mental accounting. Budgeting apps, expense trackers, separate digital wallets. These tools can both help and harm financial behavior. Psychological basis of mental accounting. Mental accounting is rooted in 1. Cognitive simplification. It simplifies complex financial decisions. 2. Emotional attachment. People attach emotions to money based on its source. 3. Self-control mechanism. It acts as a tool to control spending. Importance in economics. Mental accounting challenges traditional economic theories by showing that people are not always rational. Emotions influence decisions. Psychological factors play a major role. It has contributed to the development of behavioral economics. Mental accounting is a powerful psychological concept that shapes how individuals manage money. While it helps in budgeting and financial discipline, it can also lead to irrational decisions and inefficiencies. Understanding mental accounting allows individuals to make better financial choices by recognizing their biases and treating money more rationally. By balancing emotional instincts with logical thinking, people can improve their financial well-being. Ultimately, money should be viewed not through fragmented mental categories, but as a unified resource that should be managed wisely and efficiently. Mental accounting reflects the human tendency to simplify financial complexity. While it is not entirely avoidable, awareness of this behavior is the first step toward better financial decision-making.